In this video, I'll tell you exactly how to build a passive income stream with ultra-high dividend investing, and we're starting right now. Hey guys, Elliot here. So if you followed my channel, you know that I'm a big fan of dividend investing. It's a popular approach and it's easy to see why. You buy stock from companies that pay dividends, and every month or every quarter, you get a dividend payment deposit into your brokerage account. You can then reinvest the dividends or withdraw them. Now, if you're not too familiar with them, dividends are sums of money paid regularly by a company to its shareholders out of its profits. It's really nothing more than a company paying you to buy and hold its stock. This sort of income can really add up and eventually become a reliable passive income stream. In fact, that is exactly how some dividend investors hope to retire, and dividends are the basis for the financial independence retire early movement or FIRE, where people look to invest enough that they can live off the dividends. And it's here really that the difficulties with this approach start. The problem is that even though a significant majority of companies distribute dividends, in most cases it's just not all that much. Take for example Walmart, one of the best known corporations in the world. As I'm filming this video, its stock is hovering around $90 per share, but its annual dividend yield is 0.92%, which is just 21 cents per quarter or 84 cents per year per one share. To put that into perspective, if you spend $950 and buy 10 shares of Walmart, your annual dividend from those holdings would be a whopping $8.40. Not exactly generational wealth. It doesn't get any better with a tech giant like Microsoft, which has a dividend yield of just 0.79% with a share price of $418 at the time of this filming. That works out to 83 cents per quarter or $3.32 per year for one share, or about $33 if you splurge $4,180 for 10 shares. Needless to say, these dividends are also not what you'd call retirement cash. Now, of course, there are plenty of solid blue chip companies that pay out a higher dividend yield, but even in those cases, you're looking at somewhere between 2 or 3% at most. That means that even if you somehow manage to buy up $1 million of such stock, your dividends would amount to somewhere between $20,000 and $30,000 annually, which is more, but it's certainly not enough to retire on in most parts of the country. And of course, never mind the fact that most people will have a lot of trouble cobbling together a $1 million portfolio. Clearly, this approach, while fundamentally sound, needs to be tweaked significantly so you can earn dividends that are far higher than 2 or 3%. This is where ultra-high dividend investing comes in. The idea here is fairly simple. There are certain classes of stocks that pay out much higher dividends, somewhere in the 5 to 10% range or more, but they come with a correspondingly higher risks. The trick is to find a select group of companies within these asset classes where the risks are manageable and they are balanced out by the rewards. This kind of investing will require you to do some research and have some significant knowledge and experience to be able to determine which of these companies are worth the investment risk and which ones are not, despite the attractive dividend yield. So to start things off, what are these asset classes? I would recommend the following 5 as the primary ones to focus on. The first one is business development corporations, or BDCs. The second is closed-end funds, or CEFs. The third group is real estate investment trusts, or REITs. The fourth is covered call ETFs, and the fifth is energy companies with a special focus on midstream partners. In the past, I've also had several secondary asset classes that included tobacco and telecom stocks, but these do come and go into my portfolio depending on the current state of these industries, while the 5 primary ones I mentioned tend to stick around long term. So if you've never heard of these asset classes, perhaps then a quick review. The first asset class I mentioned is business development corporations, or BDCs. These are organizations that invest in distressed companies as well as non-distressed small and medium-sized firms. In all cases, they help these companies turn their business around and grow to a stable level. BDCs typically buy up a significant stake in the companies they are assisting and profit when shares of these companies appreciate or the companies are sold off. Examples of BDCs include Ares Capital, ticker ARCC, Barings, ticker symbol BBDC, and Main Street Capital, ticker symbol MAIN, and they typically pay dividends anywhere from 7 to 13%. The second class I mentioned is closed-end funds, or CEFs. These are mutual funds that are closed-end, which just means they don't accept new funding once they get going, which allows them to use leveraging and other risky financial tools to increase income. Some examples of CEFs include the Aberdeen Fund, ticker AOD, PIMCO Dynamic Fund, ticker PDI, and the Brookfield Fund, ticker RA. These funds pay dividends in a range of 8 to 14%, and if you want to learn more about them, I have a video dedicated to CEFs with a link in the description below. The third asset class I mentioned is real estate investment trusts, or REITs. REITs are synonymous with commercial real estate as they essentially buy up commercial properties and make their money by charging rent. They are an excellent investment option for just about any investor and the easiest way to get a foot into commercial real estate without actually buying properties. Examples of of REITs include National Retail Properties, ticker NNN, Realty Income, ticker O, and WP Carry, ticker WPC. REITs generally pay a bit less, with 4 to 6% being typical, but on the plus side, you do get decent share appreciation as well. The fourth asset class I mentioned is covered call ETFs. They are funds that write and sell covered calls against stocks in their portfolio, and some examples include ticker symbols QYield, XYield, RYield, JEPI, and NUSI. These ETFs write calls against the Nasdaq, the S&P 500, and the Russell 2000 indexes, as well as some combination of these, and they pay dividends in the 9 to 14% range. The fifth asset class I mentioned is energy stocks. Now, these aren't just your typical oil and gas companies like ExxonMobil. While they are certainly worth holding, the dividends paid are not very high. The ones I recommend focusing on are what are called midstream partners. These are companies in the business of storing and transporting the oil and gas. Think pipelines and storage tanks, not actually drilling for oil or selling it on the retail side. There are two reasons midstream partners are such good investments. For one, they pay excellent dividends, with most being in a 7 to 9% range, and other is price stability. Midstream companies make money regardless of the cost of oil and gas, with both being notoriously volatile in price. However, whether they're up or down, midstream companies make the same money as the oil and gas still needs to be transported and stored. Some examples include Enterprise Product Partners, ticker EPD, Magellan Midstream Partners, ticker MMP, and ONEOK, ticker OKE. Well, there you go. The secret to a high dividend portfolio is investing in a whole new set of investments that you may not have considered before. Business development corporations, closed-end funds, real estate investment trusts, covered call ETFs, and midstream energy corporations. You will still need to do your research carefully, as among these categories, as with anything really, there are good and bad investment choices. The examples of stocks in each asset class that I listed were just that, examples, and while I certainly hold many of them, you should absolutely do your own research, and in upcoming videos I will tell you exactly what I look for when I research these stocks myself. If nothing else, you'll expose yourself to some new and interesting investing ideas and possibly make some money along the way. Okay, that was a quick explanation of ultra high dividend investing. As always, if you enjoyed this content, please do like and subscribe, and I'll see you in the next video.